Hello everybody, and welcome to our latest webinar covering the new standard IFRS 16 on leasing. Now before we get started, I just wanted to talk a little bit about the new knowledge management application for IFRS, the desktop application that many of you are using. There's a new version of the application that's about to be released in the next week, and it's got some really nice enhancements to it. Just to point out a couple of those, the first and foremost one is we've now licensed all the IFRS standards from the ISB, which are now included in the application. What this will allow you to do is it'll allow you to view standards and also search for various standards. So if you're searching for something on property, or you're searching for something on Forex or leasing, whatever it may be, you'll be able to do a search of all the standards and the interpretations that'll bring up results for you in that. Nice thing about the standards is they're available both online and offline to you using the application. So when you are doing that, you'll be able to search for them, as I say, when you're offline and online, giving you access to the standards whenever you may need them. Secondly, we've also enhanced the e-learning and allowed you now to choose what modules you want to download. So you could download specific standards e-learning, or you could choose to download all the packs relating to Microsoft Office, to the webinars, to the IFRS e-learning, whatever you're looking for. So as those updates come along, they'll be a lot smaller and simpler for you to download. Thirdly, we've also kind of streamlined the entire look and feel of it with a much more user-friendly interface, including that search bar of the standards up front. And of course, there will also be something called a monthly news bulletin. So for those of you who want to view a news bulletin on the latest standards, there will be a little button. You'll click on it and you'll be able to see the latest developments in IFRS. We're going to run those once a month, probably for about between 3 and 5 minutes, really just giving you that quick monthly bulletin on what's been happening in the world of IFRS. So keep an eye out in the next week. That should be launched shortly. For those of you who don't know anything about it, you can always email us and we can give you some information on this. You can just email support@fundamentals.co.za. That is the support desk for that, and I can send you a whole lot of information. So yeah, that's just a bit about the application that will be launched shortly. Now, let's get into what we're looking at today, and that is the new standard IFRS 16 on leasing. Now, this standard has been a long time coming. The ISB has been working on it now for must be about 6 or 7 years, and is one of the standards that they were working on in conjunction with the Financial Accounting Standards Board in the United States. This was, as I said up on the slide, a joint project. We kind of got partway there to a fully converged standard. The good news is that there was agreement between the two boards that we should have a single model for lessees, and we will take a look at that today. But there are some differences really in the areas of on some of the recognition principles and on the presentation of leases. So all in all, I think a good move where the two standards are fairly close together, but there are some major differences between them. I'm not going to be going into the differences with the US GAAP today, but just so you are aware that these are not 100% aligned. Now, why exactly have they issued the standard? Well, this has been quite a controversial view. Many people have always said that the major problem with leasing under IFRS at the moment is it does not reflect the commercial reality. Now, the commercial reality is very simple. If I had two people who are looking to buy, let's say, identical buildings next door to each other, let's say in the middle of the City of London, one of them manages to structure it that it ends up being an operating lease, and the other one structures it so it ends up being a finance lease. In essence, these two leases could be almost identical, but because of a few differences here or some terms of the lease there, we end up with very, very different accounting. Under the operating lease model, all the lessee would do is basically disclose in their expenses the charge every month. So every month they would expense the lease payment, and barring any straight lining of that lease payment if it was applicable, they would effectively just expense it. For the other company who's got it as a finance lease, they would have to capitalize the asset, which is great for the asset side, but then they'd also have to capitalize the present value of all the cash flows, which is a huge liability they'd put on the other side of their balance sheet. Now, as we all know, we worry a lot more about liabilities than we do assets. And with this big liability on balance sheet, that's going to impact a number of things like your debt equity ratios, various gearing ratios, interest cover, covenants that could be blown by that. So there's a whole lot of factors that impact the company with the liability. The commercial reality, though, is that both these companies have contractual obligations to pay an amount of money. I mean, that's the very simple thing about it. Both these companies over the next, let's call it 30 or 40 years, will have to pay the landlords or the lessors a fixed amount of money every year for the use of the building. But we ended up with very, very different answers. So the ISBs decide they're going to fix that, and that's what they've done in issuing IFRS 16. They've come up with a new model that does away with the concept of operating or finance leases for lessees, and we end up with a single model that says you will capitalize all leases. Now, there's a couple of exceptions and a few things that are scoped out, which I'll touch on, but I think the basic principle for you to understand is everything should be capitalized. Now, this is quite a complex standard, and there's quite a lot that needs to be looked at. So what I'm going to do is we're just really going to cover off a number of things in terms of that, and those are the ones that are on the slide now. To start off with, we'll touch on the scope. What does the standard cover? Then one of the major questions being, what is a lease? And from what we're seeing in practice already, this is probably going to be the big challenge for many companies in defining whether they do or don't have a lease. Once you know you are an IFRS 16 and you do have a lease, well, then you've got the initial measurement and the subsequent measurement issues to deal with for both the asset and the liability. We'll also just touch very briefly on what the lessors have to do, because believe it or not, there's different accounting for lessors. And then, of course, presentation disclosure and the effective date. So that's just a bit of a roadmap as to what we're going to cover during the webinar. To start off with, we're going to take a look at the scoping. And the standard says it applies to all leases, except effectively for the four things that I've listed up there. The first one are any leases to explore or to use mineral, oil, gas, similar type of non-regenerative resources. Those are scoped out of the standard. Contracts that are covered by the IFRS 12 on service concession arrangements, for example, things like toll roads, those are scoped out, as IFRS 12 specifically tells you how to deal with those. If you are a lessor, any licenses for intellectual property that fall within IFRS 15, remember that's a new standard on revenue, those are scoped out of the standard. And on the other side, if you're a lessee, if you are leasing things like biological assets that fall into IS 41 and agriculture, or effectively any rights held under a licensing agreement for intangibles for things like films, videos, plays, etc., those are also currently scoped out of this standard. Other than that, everything else is in. But there is one big exemption, and that is the following. The ISB decided to put in an exemption for what they call kind of your small and short-term assets. Now, the general principle here is that they say all leases need to be accounted for under the single model, which is effectively a capitalization model. Except, however, they did say we're going to give you one exception. And that exception, to start off, says any short-term assets or any low-value items, you can keep the old operating lease accounting. What that means effectively is if you've got something that's of a very short period or something of a low value, you can just expense it on a straight line basis over the lease period. You do not need to worry about anything else. Now, many of us love this model, so we're saying, great, well, how can we get things in there? Well, as I said, you need to meet one of the two requirements we spoke about. The first one says effectively, you need to be in a lease that is of a short term. And they define the short-term lease as anything less than 12 months. Now, I am going to come back and touch a bit more detail on what lease term means later. But in essence, the lease term is summarized as the non-cancelable period, including any extensions where it's reasonably certain that these will be exercised, and of course any other periods covered by an option to terminate where we know you're not going to terminate. Now, I think a lot of people are going to try and kind of use a crowbar to get leases into the standard, and I think they're into this section. And I think a lot of people are going to try and say, no, what we'll do is instead of a 10-year lease, we'll do 10 one-year leases. I think that sounds great in theory, but from my experience, that's going to be very difficult in practice. The reason I say that is because for landlords or lessors, they want the certainty of the cash flows. And for you to sit and say, don't worry, trust me, we'll renew it, I don't think that's going to be good enough. Remember, you can't say we'll sign 10 one-year leases unless you're contractually bound to take them, or it's commercially reasonable that you will take them. So I think to really get into this, we really are dealing here with very short-term assets. So for example, I go to Imperial or Budget to rent a car for 6 months. For a staff member, that's going to be scoped out. I'm renting a computer for 6 months while something's being fixed, we would do that. This really is designed for your short-term leases. As I said, anything that genuinely you will utilize for less than 12 months and will not be extended. A couple of things about this just to point out. The first one, of course, is that the lease may not include a purchase option. So if the lease, the short-term lease has got the option where you can buy the asset, then this exemption doesn't apply. Secondly, you've obviously got to comply this consistently for each class of underlying leased asset. So if we're saying, well, we're going to use exemption for all the mobile phones that we happen to rent, and all the mobile phones on less than 12 months contracts or something like that, then of course those would be scoped out. And of course, if the lease is modified or there's some sort of change in that lease term, that's considered a new lease and you would potentially need to relook at it and capitalize if possible. So as I said, really this is aimed at your short-term leases. The second exemption obviously applies to what they call low value items. And the idea of the low value item is saying that this is where they're saying if you've got assets that effectively meet these two requirements, you can use the exemption. In other words, the old operating lease. The first one says assets where the lessee can benefit from the use on its own or together with other resources readily available to it. And of course, the asset is not highly dependent on or highly interrelated with other assets. So providing you've got a small asset, these things can be used on their own. Effectively, the standard would scope those out and you can use operating lease. This is really aimed at your small things. And the ISB gave examples. This is where we've got things like mobile phones, cell phones, computers, furniture, tables, things really that can be utilized themselves. Now, the one thing that is strange about this is that many people have said, well, how do we decide when something is low value? Well, there's a couple of factors you need to take into account. Firstly, the assessment is based on the value of the new asset regardless of its age. Okay, now that's quite a strange thing. So if you rent a car that's in its 4th year of its life, you would assess that as if it was a brand new car. You don't look at the age of the asset, you look at the value of this asset if it was new. So that's something you would have to take into account when looking at that. Secondly, the entity applies this regardless of the materiality of the item to the lessee. So we're looking at this exemption really on the basis of the asset itself, not necessarily materiality to you as a company. Thirdly, entity-specific inputs are not relevant to the classification. In other words, what they're saying here is all companies should come to the same answer on assets in this category. Now that's going to be quite interesting because, I mean, if you've got a company with a $100 million market capitalization, or you've got an SME that effectively is worth about $2,000, effectively they're saying the same assets should receive the same treatment. So what they're trying to say here is all assets really of small size, no matter how big the company is, should fall into this exemption. And of course, this is applied on a lease-by-lease basis. Now, as you can see, everything's building up here to saying, well, if we're applying this regardless of age, regardless of value to the company, it's all kind of one number. Do they give us a magic number? Well, as you can appreciate, no, they didn't give us a magic number. But believe it or not, the ISB did refer to a number in its basis for conclusions. And that number was, they're saying that they would believe these are assets worth $5,000 or less. Now, as many of you around the world are watching this, I'm sure many of you in the more developed countries will look at you and say, well, $5,000, that's small, we don't need to worry. But I will tell you, $5,000 in some countries is quite a lot of money, especially in the developing nations, where assets of $5,000 could be material. Remember that $5,000 is in the basis for conclusions. It's not authoritative. It's a guideline. I think every country, every company will need to work on its own guideline, but I just put it out there more for reference. I think I would worry more about the type of asset as opposed to anything else. What's quite interesting is that they refer to $5,000, whereas, I mean, a computer of $5,000, you can get computers worth a lot more and a lot less. So I think this is going to be a very, very judgmental area. But we'll have to wait and see how that applies in practice. So that effectively is the scoping of the standard. Okay, key things to point out there: it applies to almost all leases, except of course those which have a short-term life. As I said, less than 12 months, and we don't expect it to be renewed. And secondly, are of a low value. And as I said, they haven't really defined that low value, but you'd look at assets of low value, and those can all be accounted for straight line. Other than that, everything else falls within the standard. So now we get into the difficult bits. What exactly is a lease? As I said when I started out, I think this is where most of you will spend a lot of your time in practice trying to apply the standard. If I take a look at some of the issues we're facing, the first thing talks about the definition itself. It says a contract is or contains a lease if the contract conveys the right to control and use an identified asset for a period of time in exchange for consideration. Now we are going to break that down, but the key things to point out about that is a number of things. Firstly, it's a contract, so it's got to be something that's binding on the parties. Okay, it conveys the right to control the use of an asset. Let me repeat that. Conveys the right to control, there's an issue around control there, to use an identified asset for a period of time in exchange for consideration. So we can define the period over which you're allowed to use it and you're being paid for it. So a number of factors there we'll need to take a look at. As I mentioned, one of the things I have put into that definition is the concept of control. Remember, control is defined as the right to obtain substantially all the economic benefits from using an asset and the right to direct the use of the asset. Now you'll see now how that right to direct the asset actually quite heavily impacts whether or not you are in the leasing standard or not. Very importantly, this assessment is made at inception of the lease. So you make it on day one, the day effectively you sign the lease, and you only have to reassess this if the terms of the contract are changed. Now, one of the errors I still see even under I-17, the current leasing standard, is people believe you need to re-look at leases every year. You don't. This current standard I-17 and the new standard has the same principle, and that is that once you've done a lease assessment, unless the terms change, you keep that lease assessment kind of for the entire life of the contract. Please do remember that, especially those of you in the audit game, because we see a lot of the auditors going in every year and getting the trainees to go and re-audit leases. If there haven't been any new leases and no changes in the contract terms, you do not need to do that. Okay, please give thought to that. Now, how do we determine whether we have a lease or not? If we break everything down effectively, if we look at the definitions that I spoke through earlier, I've put that into a flow chart here, and this will be much simpler for you. We start off at the top, and the first question we ask ourselves is there an identified asset? Let's take a look at that in a bit more detail. An asset can be identified one of two ways. It can either be explicit or it can be implicit. Now, what I mean by that is the following. To start off with, explicitly means I have identified a specific example. I've given a wonderful example there of a Porsche 911 Turbo. If we said that you're going to lease a Porsche 911 Turbo from, let's say, Porsche in Germany, and it will be the one with registration ND1342, there we have explicitly identified an asset. It is only that asset. It's not the one next to it. It's not the one that's going to be produced next month, because there is one that identified by a registration number. Implicitly identified could be something very similar. So I'm saying I'm going to provide something which I've implied what that asset will be. It will be a packaging machine model X876 is what I've put there. Remember, very importantly in terms of that, I haven't said exactly which one, serial number, whatever it may be, but we've implicitly identified that is the packaging machine that can be used. You cannot use another model to service me with it because that's the one that I want to be leasing. So there are two ways in which you can identify it. Well, then the question obviously is where it's explicit, it's easy. Where it's explicit, I know I'm provided exactly with a certain type of asset. But what if it's implicit? Can the supplier then substitute the asset? Well, the standard says an asset is not identified if the supplier has a substantive right to substitute the asset during the lease term. Now, what that means is, what substantive effectively means is that the supplier has the practical ability to substitute that asset and the customer can't stop that happening. Okay. It also says that the supplier would benefit economically from the substitution. So an example of that could be if I'm leasing you a computer server. I then say I have the right to substitute it. If I can at any point walk in and substitute and say, well, I'm actually giving you another server. Yes, it does the same thing, but the next one effectively is better for me because I'm making more money. In other words, the next one is cheaper for me to run than the current one you've got. You're still effectively receiving the service, being whatever the service is that computer server is providing, but I'm allowed to substitute it with one that benefits me economically. Then in that situation, you have what's called a substantive right. If there is a substantive right of the lessor, the lease does not meet the definition of a lease. Substantive, of course, is determined at inception of the lease. Remember, as I said, like anything, on day one, and you base it on the circumstances available at that date. So, for example, if I'm leasing you once again a computer server, I can't take into account something in the future. So I can't turn around and say, well, I believe that we've got a 5-year lease, but I believe that in year 3, new technology will allow me to substitute it, and therefore I can make a benefit then by substitution. I'm only looking at it at the date of inception, saying, what can I do now, and is it substantive today? It also says that a substantive substitution does not exist where the asset is substituted, where it needs repairs or is broken. And I think that makes a lot of sense. So if I'm renting you a certain type of asset, if that asset breaks down and I bring in another one either temporarily or I have to replace it because quite simply it's broken down, that would not be a substantive. That's clearly just an obligation I've got within the lease. It also says that if you can't determine a substantive right, the presumption is that it's not there. So very easily we're saying there the presumption is more that you are within the asset, within the leasing standard than outside of it. Next thing it says is, can you then lease a portion of an asset? And the simple answer to that is, well, yes. It says you can lease a portion of an asset provided that that portion that you're leasing is physically distinct from other parts of the asset. So what do I mean by that? Well, here's an example. Starcom leases 10 1 gigabit fiber lines in an undersea cable, and the lines that they lease are numbers 101 to 110. So the example in the Starcom one is I'm leasing 10 strands within an undersea cable, and they are specifically the strands labeled 101 to 110. A second company, Telnet, leases a 10 gigabit capacity from the undersea cable provider. Are these two treated the same? Just want to give you a couple of seconds to read those two again and decide, would you treat these two assets in the same way? Now, the answer to this is no, you wouldn't. Okay, why? Because they're slightly different situations. In the first one, I am leasing 10 fiber strands, okay, which means I can specifically, distinctly say those are my 10 lines, and if line number 105 breaks, well, then that's my problem, or well, they may need to fix it, but I know my line specifically has broken. In the second one, I'm leasing capacity, 10 gigabytes within a pipe. We don't know which fiber lines relate to it. They're not distinct. I just know I'm getting 10 gigabytes out. Now, in this situation, you must be it's quite an interesting one, because what you can see is you can see that we have a situation where you're getting a different answer the way it is structured. Does that provide a situation for people to structure their leases? Yes, it does. If you're in a situation where you don't want to be in the standard and you can more lease capacity as opposed to just the specific lines, then there is potentially a way to do that. So you just need to be very careful here that there will be quite specific terms that could kick you in or kick you out of the standard. I will point out there are a number of examples of this in the IFRS 16 standard. If you take a look at the examples, you see quite a detailed section on examples on this. Obviously, we don't have the time to go through all of them, but if you do a lot of leases or you have clients with a lot of leases, I would seriously encourage you to spend some time taking a look at those. The second question says, if we do believe we have an identified asset, it now says, does the customer have the right to obtain substantially all the economic benefits from use of the asset throughout the period? This is part of that control definition we took a look at earlier. Now, how do we determine whether you have substantially all the economic benefits? Well, the standard says that the customer has to be receiving all those economic benefits from the asset throughout the period. Now, those benefits arise from various areas. To start off with, it could be, for example, exclusive use of the asset. So I'm the only person who can use it. I could also have the right to sublet the asset and earn rental from that. That also gives me all the benefits. And of course, things like the primary and the byproduct cash flows. Who's receiving all the cash flows arising from these? Now, whenever you're making the assessment of substantially all, you need to look at that in terms of the scoping of the customer's rights under that contract. In other words, what are the rights they've got under the lease, and are they getting all the benefits from that? Let's take a look at an example of what I'm talking about. It says a contract specifying a new car may only travel 10,000 kilometers per annum must be assessed within those parameters. Now, what we're saying there, for example, is if you go and you rent a car and the lease says you may only travel 10,000 kilometers per year, you can't then say, well, hang on, I'm not getting all the benefits. You are getting all the benefits. If you're the only person driving it for that 10,000 kilometers, then you're getting substantially all the benefits. Even though the lease contract restricts the number of kilometers per annum, you're getting all the benefit within that restriction. So as I said, you've got to look at it in terms of the contract and say, of the benefits within the contract, in other words, the 10,000 kilometers in my example there, am I getting substantially all of those? If the answer is yes, then you're within the leasing standard. Once we've determined that we do have the right to obtain substantially all the economic benefits, the next question we all have to ask ourselves is who directs how and for what purpose the asset is being used? Now, this one can be a bit tricky because there are a number of parties involved who could effectively direct how the asset is used. It could be the customer themselves, it could be the supplier, or potentially it could be neither party. Let's take a look at these different permutations. The first thing you have to ask yourself and determine is who directs how and for what purpose the asset is used. And the examples here around the decision making include things like, can somebody change the type of output? So for example, if I had a shipping container, Could I choose to take that shipping container and use it to transport goods on ships, or could I use it for storage? Who makes that decision? The second one, could I change when the output is produced? So could I take a machine and decide to just turn it off and not use it for 3 months? Thirdly, can I change where the output is produced? So could I take something, for example, there I've got a delivery truck and move it from one country to another, or from one part of a country to another, or is it predefined that it can't? And lastly, can I change the quantity of output? So can I elect to either increase or decrease the output from the machine? Now, these are the types of decision makings you need to look at, because these determine who effectively drives the decision on how and for what purpose the asset is used. Why is this important? Because this drives our lease classification. If the supplier, in other words, the lessor, determines these type of things, so they have the decision-making power, then this is not a lease. Then you're scoped out of the leasing standard entirely. If, however, the customer, being the lessee, has the decision on how to effectively make, well, it has all these decisions that we've discussed up on the screen there, then this is a lease with an IFRS 16. Now, the question always comes out then, well, if we've decided who's got the power, what if neither party has? Let's take a look at that. If neither party has this right, well, then the only option then must be that all the rights are predetermined in the agreement between the parties. Now, that can happen, for example, where we've set up a contract and we've predefined from day one exactly how it will operate, where it will operate, the times it will operate, the type of output. Everything has been predefined in the contract. How then do we determine whether we have a lease? Well, the standard says the following. It says, if the how and for what purpose is predefined, then the contract is only a lease if the customer has the right to operate the asset without the supplier having the right to change the operating instructions. So let me repeat that in a different way. We're saying you're only in leasing if, even though things have predetermined, the customer can operate it within those parameters and the supplier or the lessor cannot change anything within those operating instructions. Once again, then we're saying effectively there's a degree of control there that's falling to the lessee, and therefore I am within the standard IFRS 16. So what if the customer designed the asset in a way that predetermined how it will be used? Well, if the customer was involved in designing the asset and effectively they've decided or predetermined how and for what purpose the asset will be used, then this is going to be a lease. I think this is one where we're going to see a lot of people trying to get out of leasing but are going to be caught by it because it's a pretty blunt instrument. It's saying, if, for example, I was building a factory and I went to somebody and said, I want you to build me a factory and I'm going to lease it from you. If I went and designed, well, this is what I want the factory to look like, this is how I want it, this is where I want everything, and this thing was basically custom built for me to meet my specific requirements, then the standard is putting you straight into leasing and says you fall within it. So this is a bit of a tricky bit, deciding, of course, who has the control. Let's take a look again at the flow chart. So if we just go to the middle bit there, we're saying, does the customer, the supplier, or neither party have the right to direct it? If you go down the left side, you'll see, well, if the customer or the lessee has got the right effectively to direct how and for what purpose the asset is used, then we definitely with an IFRS 16. On the right, as we said, if the supplier, they effectively have all that control, then this is not going to be a lease. If neither party has got it, as I said, there's a level of predetermination, then you jump down to the second last box. And that says, does the customer have the right to operate the asset throughout the period of use without the supplier having the right to change those operating instructions? If the answer there, again, is yes, then once again we have a lease. If the answer to that is no, the last thing it says to us is, did the customer design the asset in a way that predetermines how and for what purpose the asset will be used? In other words, once again, this is effectively a customized asset. If the answer to that, as we saw earlier, was yes, you're within leases. If it's no, you're outside leasing. As I said when I started off this section, I believe this is where the majority of you will spend your time, determining whether you are in a lease or not in a lease. This is an important slide. If you want it, let me know. I'll happily email it out to you. Print it out, put it on your mirror in the morning when you're getting ready, whether you're doing your makeup, you're shaving, whatever you may be doing, keep reading through it. This is the one that you're going to need to apply. Because once you know something is or is not a lease, well, then I think the standard's actually not that difficult. I think the rest of it's quite easy. You just have to apply the mechanics. But this is where I believe there's going to be a lot of consultation, a lot of advice being sought as people are going to need some help. Now, let's just take a look at a couple of examples because I think that could help. Here's my first example. Commodity Trading enters into a contract with RT Logistics, it was a trucking company, for the transportation of grain from Beira to Lilongwe and tea on the backhaul to Beira. The trucks to be used are specified in the contract, and the supplier does not have the right to use alternative trucks. The contract specifies the goods to be transported and the dates of pickup and delivery. RT will not be able to transport any other goods during the current term of this contract. RT Logistics operates and maintains the trucks. Commodity trading is prohibited from hiring other trucking companies to operate the trucks itself during the term of the contract. Does the contract contain a lease? I'm going to give you 30 seconds to look at this and decide, would you put this in IFRS 16? Right, now let's take a look at the solution. In this example, the contract does not contain a lease. Why? Well, let's work through the theory. Firstly, there are identified assets. Remember, the starting point in our flow chart says, is there an identified asset? And I think in this situation, you'd all be happy there is. The trucks are explicitly identified, and RT does not have the right to substitute the specified trucks. So we've ticked off the first box. Moving our way down, the second thing says, does the customer have the right to control the use of the trucks during the period of use? I think they would. It says there, they have the right to obtain substantially all their economic benefits over the period of the use. Clearly they are, because they're getting 100% of the use out of the trucks. And the goods will be utilized substantially all the capacity of the trucks. And by doing that, they are precluding others from using them. So they've kind of ticked the first bit. But the second bit causes the problem. It says the customer does not have the right of control, as they can't direct how and for what purpose the trucks are used. This is predetermined in the contract and cannot be changed during the period of use. So what we're saying is, because everything in the contract is predefined, they cannot change anything. They can't direct it. Remember, we set the dates, what they have to take, where they're taking it, where it's coming back from. Nothing effectively is within the control of the customer on that stage. So because they don't have any control in terms of that, they get kicked out. All that control effectively is removed from the customer or the lessee, and they're therefore not in IFRS 16. Let's take a look at a second example. Commodity trading again enters into a contract with RG Logistics, a trucking company, for the use of 20 trucks for a 3-year period. The trucks to be used are specified in the contract, and the supplier does not have the right to use alternative trucks. The customer decides what cargo will be carried, where and when it will be carried to and from, subject to restrictions specified in the contract, such as the carrying of hazardous materials and driving through conflict zones. RT Logistics will not be able to use the trucks to transport any other goods during the currency of this contract. Now, RT Logistics operate and maintain the trucks. Commodity trading is prohibited from hiring another trucking company or operating the trucks itself during the term of the contract. Do you think this contains a lease? Once again, I'm just going to give you 20 seconds to take a look at this. So this example is slightly different here, because what we've done is we've more said we are hiring in 20 trucks as opposed to we're just hiring you to do some deliveries for us. The main thing to point out here, however, is that there are some changes in the way they've structured it that do actually end up in this being a lease. And let's take a look at a solution. The standard does contain a lease for the following reasons. Firstly, the customer has the right to use the trucks for 3 years. So it's an asset specified. They get to use specifically identified assets over a period of time for which they will have to pay. As we said, these are identified assets, so we've met that because they've explicitly identified them. And in this situation, there's no right of substitution, so that factor doesn't play in. We've also said that the customer has the right to control the trucks throughout the 3 years. Why? Well, for these two reasons. Firstly, the customer has the right to obtain substantially all their economic benefits because they get to use them solely for the 3 years. And secondly, the customer will have exclusive right over the assets for the period. We've also said here that from the facts, you'll see that the customer has the right to direct how to use them and for what purpose they will be used. Yes, there are certain restrictions like the carrying of hazardous materials or going into things like conflict zones, but within the parameters of the contract, the customer in this situation basically has effectively unilateral control over what they do with the trucks. As a result of that, they will fall into IFRS 16. Now, these are just two simple examples to show you how small differences, once again, in the way you structure it can end up in you being in or out of the leasing standard. Please note there are, once again, numerous examples in the appendix to IFRS 16, and I'll suggest you do take a look at those in practice. Now, what if an agreement contains a lease and a non-lease component? How do you deal with that? Start off by looking at an example. The mining co leases a heavy-duty drill, compressor, and front-end loader from the leasing co. The leasing co will maintain the equipment throughout the lease, and in return, the mining co will pay an amount of $500,000 in installments of $100,000 per year for 5 years. The amount includes the cost of maintenance service. Several companies in the area are accredited service providers for the equipment and have provided their pricing, which averages around $25,000 per annum. Standalone prices for the lease of equipment are available for the drill and front-end loader only. Now, how would you account for such a contract? Clearly, you can see we've got two things within this. Firstly, we've got the right to use assets, and the second thing we've got a maintenance contract. So how do we deal with these under IFRS 16? Standard says quite simply, separate them. You need to separate out the leasing component and the non-leasing component. How do you do that? Well, effectively, you allocate the consideration on the basis of relative standalone prices of the lease component, and of course the aggregate standalone price of the non-lease components. So what you need to do is you need to go out and work out effectively what value in the contract relates to the leasing components, what value relates to the non-lease component, and split those out and account for the two separately. Now, there is a practical expedient. What that means is the ISB has given you a bit of a gift and said, look, if effectively accounting for these two is going to be difficult, so you're looking at the contract and it's just too complex to try and work out what's lease, what's not, or you can't get pricing for them separately, it says as a practical expedient, you can just account for the entire thing together as a lease. Now, let's take a look at our example of our mining company. So how would they effectively apply this or apply the practical exemption? If they chose to apply the practical expedient, well, then that's easy. All they would effectively do is they would apply the leasing standard to the entire contract effectively as a single leasing component. Just note one thing I have stated there, of course, that this practical expedient is not applicable where you have an embedded derivative within the lease. Remember, embedded derivatives are any derivatives that are hidden in non-financial contracts, and IFRS 9 and IAS 39 currently tell us that you need to take those out and account for them separately. So this doesn't apply in our mining example because it's a service contract. So here, let's just say under the practical expedient, they just account for the whole thing under IFRS 16. If they choose not to apply IFRS 16 to the entire contract, then once again, they would need to go out there and split it out. And as I said, here what I've done is I've split out the different items. We've split out the lease for the compressor, the heavy-duty drill, and the front-end loader. We've also split out the maintenance contract separately, and it would account for the total consideration of $500,000 split between the lease component and the non-lease component. So that effectively is deciding on when you have a lease. Once you know you've got a lease, the next thing it says to you is, so what exactly is the lease term? Now, we started looking at this definition up front, and we said effectively the lease term is defined as the following three items. Firstly, the non-cancelable period. Secondly, any extensions that you're reasonably certain you may exercise. And thirdly, any period covered by an option to terminate it, where it's reasonably certain that you will not do that. Now, let's just look at these three things in detail. The first thing you need to look at when you look at the lease term is what is the non-cancelable period. This is effectively the period of the lease that is enforceable. So the term that you'd see in the contract, it starts at the commencement and it does include any rent-free periods. So for example, if you're renting a building for 5 years, but it says you get the first year free, we would consider the lease term to be 5 years. Why? Because that's the entire period. I also say, remember, nothing's ever free. It's built into the price. So the non-cancelable period is exactly as it says, that period that you have to carry out the lease term. The next two then talk to, well, what if there are options to extend or cancel? And it talks about including in the lease term, firstly, any extensions where it's reasonably certain that these will be exercised. And secondly, any period covered by an option to terminate where it's reasonably certain that this will not be terminated. Now, these two things are in essence the same thing. It says you need to consider all the relevant facts and circumstances and the economic incentive around why a lessee would act in a certain way. So if I said to you, you can lease a car for the first year and it's going to cost you $5,000 a month for argument's sake, but then for the next 2 years after that, it'll only cost you $1 a month. Well, in that situation, we know that very clearly you're going to exercise the next 2 years because we can see quite clearly that it makes economic incentive for you to do that. In that situation, we would see the lease term as 3 years. The same way, if we had a lease and said, well, you've got a 5-year lease over an office building or some office space, You can cancel within the first 12 months, or you can cancel any 12 months thereafter. In other words, trying to get into that exemption. But in the first year, you go and spend $1 million outfitting it to turn this into the most glamorous, beautiful office ever. We can see very clearly that there's an economic incentive there that you wouldn't want to move. I mean, you wouldn't have recovered the value of the outfit. You wouldn't. There's a cost of relocating. All those things would be taken into account. So all I'm trying to say here is that wherever you look at lease term, you do need to take into account all the facts and circumstances in determining the true lease term. I think this is really drawing on that principle of substance. So what is the substance lease term over purely what is the legal form in the contract? So that's the question around, is something a lease? And as I said to start off with, I really think that this is an area where many of you in practice are going to spend a lot of time trying to determine whether or not something falls within the standard. Now, as I said up front, once you're in the standard, then I think that it becomes a bit easier, because now effectively you just move into doing the mechanics of the accounting. And let's take a look to start off with at the initial measurement. Now, at the initial measurement, effectively, you're required to recognize both an asset, being a right to use the asset, and a liability. As I said, this is a single model leasing standard. In other words, it's not like the old one where we would say what is a finance lease, what is an operating lease, and then a very different accounting. For lessees, if you're in the standard, there's one model, and that is the one on the screen. Capitalize the asset and capitalize the liability. Now, how do you measure those? Start off by taking a look at how you measure the liability on day one. Now, it says here that the lessee must recognize the lease liability as the present value of the lease payments not paid at the commencement date. Okay, so effectively it says you take all the unpaid lease payments and effectively you present value those back, discounting them at the implicit rate in the lease. What's very important here, the implicit rate, of course, is that rate that at commencement of the lease discounts the lease payments plus any residual value of the asset, effectively back to being the fair value of the asset today. That's the same as we had under ICE 17. Remember, if you can't determine the implicit rate, you can use your incremental borrowing rate in doing that discounting. Now, what's included within lease payments? Well, to start off with, your lease payments include any fixed payments, less any incentives. Okay? It does say you also include something called your in-substance fixed payments. Now, what exactly do I mean this? It says these are payments that are structured effectively to look like variable payments, but they are really unavoidable. And some of the examples I've given there are things like variable payments where the variable clause has no economic substance, or there's more than one set of payments, but only one is realistic. So anywhere where effectively we're trying to structure something that looks like a variable payment. Now, why would you want to structure something as a variable payment? Because variable payments are excluded from the lease payment. So if I said to you, I'm charging you $5,000 for your rental of a retail store, plus I'm charging you 1% of your turnover. If we had determined the $5,000 was the genuine fixed amount, the 1% was a variable amount, I wouldn't include that in my liability up front. So many people try and structure things within lease. However, what we have seen a situation is where people would rather turn around in that situation and say, well, hang on, let me lower the fixed amount to $1,000. So I'm going to charge you $1,000 for your retail space, but then I want 5% of your turnover. If we can see that economically that never happens in practice, it's not the way it works in your market, then clearly we would adjust for that. So fixed payments need to include what we call the in-substance fixed payments. Secondly, we then include the variable lease payments that depend on an index or a rate. Okay, so this is, as I mentioned up front, we generally exclude variable payments, but you're only including those that are linked to some sort of index. So for example, if your lease is linked to an increase in CPI or interest rates or anything like that, those would be included within it. However, as I mentioned up front, any variable payments such as your future performance payments are not included. Those you just, as and when you pay them, you would expense them in P&L. The third one would be any amounts expected to be payable by the lessee under a residual value guarantee. So if you've guaranteed to the lessor that the asset will be worth a certain value and you had to pay in the difference, well, clearly that would be an amount that would be included within your lease payments. Next, we would include the exercise price of an option that is reasonably certain to be exercised. Now, an example here effectively is if you were given a purchase option to purchase an asset, say at the end of a 5-year lease for $10,000, and we knew very clearly that that was going to be a very good price at that stage for this asset, then you would include it into your lease terms. Obviously, you need to look at all the factors described around this to determine whether or not is something would be exercised or not by the lessee. The last one we'd look at then are payments of penalties for termination of the lease. Effectively, if the lease term reflects that the lessee exercising an option to terminate the lease. So once again, I said to you, if there is the option penalties to terminate it, and we believe that you would exercise that option to terminate at a period within the lease, you would include that within your lease payments. Now, all of these together is what makes up the lease payment. And as I said, this is the amount that you would discount and record as a liability on day one. Now, once you've recorded the liability, how then do you record the asset on the other side? Well, effectively, the asset is the other side of the journal to the liability. Now, the standard says you're going to record the asset or the right to use the asset as an asset on your balance sheet. You measure that at the value of the liability. So the calculation we just did now in terms of the lease liability, if the present value of that lease liability was say $20,000, you would capitalize the asset at $20,000. There are a number of things you would add to that. For example, any lease payments that were made before the commencement date or any lease incentives would be deducted from it. Because remember, those have already been paid. They wouldn't be in the liability, but you would include them in the asset. You would also capitalize any direct costs incurred in the lease, in writing it up, for example. And then, of course, you would also need to bring in the dismantling provision. Now, what do I mean by that? Remember, under IAS 37, if you've got a provision or an obligation to dismantle or remove an asset at the end of its life, you need to raise a provision. Well, the other side of that, the debit, effectively would be recorded against the asset here. So important to note, this could potentially be different to the liability on day one because of these additional costs. So that effectively is the initial measurement of the asset and the liability. So how do we account for them subsequently? Let's take a look at that accounting now. Let's start off by taking the accounting for the liability. Every year you need to adjust the liability by three things. Firstly, you need to increase the carrying amount to reflect the interest rate on the lease liability. So obviously as you're unwinding the interest, that will be added to that. Secondly, you need to reduce the carrying amount to reflect the lease payments you've made. So clearly that's just taking off, like you do with any loan, the actual capital repayments made. And then lastly, the standard says you need to remeasure it, the carrying amount, to reflect any reassessment or lease modifications, or to reflect any revised in-substance fixed lease payments. Now, this part can be quite tricky, and unfortunately, we haven't got enough time in this webinar to go into this in detail. But what you do need to do is where there's been a change to the lease, where it's a change in the lease term, you've changed one of the in-substance lease periods, whatever it may be, you need to look at the impact of that assessment and decide effectively how that's going to impact the lease. In some situations, you may need to adjust the asset. In some situations, you may just expense everything to P&L. But as I pointed out, there are some examples in the standard. Just be conscious that if there has been a change in the lease, that can impact on the liability, the asset, and you can end up with a P&L charge. So that's the accounting for the liability. On the other side, we've got the right to use asset. So how do we account for that? Well, here effectively the standard says apply IAS 16 on property, plant and equipment. So it says go to IAS 16 and apply the cost option there. Remember how you apply cost? It's easy. Take the initial cost, as we determined earlier. Deduct any depreciation from it, deduct any impairment from that, and of course adjust it for any remeasurements of the lease liability. Remember what I said to you, if there have been modifications, you may need to adjust. Note, however, that you are using the cost option here, which means IAS 36 on impairment of assets would also apply, which means you may need to do a bit of work around impairment of these as well. So how do we determine over what period we would depreciate the asset? Well, the standard has two pieces of guidance for us. First, it says if the lease will transfer ownership, or effectively, remember, if we measured the cost up front to reflect the fact that we believe they will exercise a purchase option, then you would depreciate it like any other asset under IAS 16 over its useful life. Note that that useful life can be shorter or longer than the lease term, because we're effectively saying this is your asset. If, however, the above doesn't apply and purely using the asset only for the lease term, then it says you'll depreciate it over the shorter of either the useful life of the asset or the lease term itself. You may not exceed the lease term in terms of that. The second option you've got is that under IAS 16, you may use the revaluation model. Now, this is a bit strange to many people because why use revaluation when effectively you've got a right of use asset? Well, you can choose to do it. The standard says, of course, that you can apply to do that, but if you do it, you've got to use revaluation on all your right of use assets in that class of property, plant and equipment. So this becomes an accounting policy choice. The third option you've got is fair value. And what it says is you may apply the fair value model to any asset you're renting that would fall into the definition of an investment property. Note over here, remember, an investment property, that's a property you're holding for capital appreciation or for rental or for anything or for a combination of the two. So you do need to meet the definition in IAS 40. If, of course, the entity elects to use the fair value model for the right of use asset that meets the definition of an investment property, it must apply this model to all right of use assets that fall within the investment property definition. So unfortunately, it's an all or nothing option here. So that effectively is your measurement. We looked at the initial measurement and the subsequent measurement of the asset and liability. And I'm hoping you'd agree with me. I don't think it's particularly complex. I think that once you're in the leasing standard, I think the accounting will be a bit easier. Now, everything I've spoken to up until now, as I mentioned in the introduction, impacts the lessee. What about lessors? Well, let's just quickly take a step out and just see how lessors are impacted by IFRS 16. The simple answer is they're not. Quite strangely, the ISB now has a completely different model for lessor and lessee accounting. For lessors, the accounting is exactly the same as it was in IAS 17. In other words, effectively, they need to do that whole finance operating lease classification. How do you do that? The same way we did under the old standard. They need to go and look at the lease. They need to assess it in terms of all the factors. And remember, there are all the indicators and things. And what they effectively need to say is, has substantially all the risks and rewards of ownership transferred? Remember, the standard does give you those indicators to help you out. We've got our primary and our secondary indicators. Noting again that the primary ones, we've always said, are the ones that would really kind of indicate that something is a finance lease if you meet any one of them. Those being whether the lease transfers ownership, there's a bargain purchase option that's likely to be exercised at inception. The lease term versus the economic life, that the lease term is for the majority of the economic life there. That the present value of the minimum lease payments amount to substantially all the fair value of the asset, and if it's a specialized asset. As I said, if you meet any one of those, you're kind of deemed to have a finance lease. There are also the secondary indicators to help you out if that didn't work. So I think the main thing to point out here is for your lessors, really not much has changed. Is this going to end up with very different accounting for lessors and lessees? Yes, it is. Are we potentially going to see the same asset on two balance sheets? Potentially we are, yes. Remember, lessor could determine something as an operating lease, which means they keep it on their balance sheet, whereas the lessee has to capitalize the asset, or at least the right to use that asset on its balance sheet. So you could see the same asset on two balance sheets. Unfortunately, the ISB just couldn't find a solution to getting lessor accounting changed that made any reasonable sense for them, because as you can appreciate, if you applied the same model of capitalizing all leases to a lessor, you'd have companies like property companies with no assets on their balance sheet. Even though they have long-term assets that can last hundreds of years, these would all effectively be sitting off balance sheet, and all they really do is have lease receivables. Some people think that's the right answer because all they are doing is providing finance in some ways, but at the end of the day, this didn't work with the leasing industry, so they have been scoped out. So that's in essence the summary, more or less, of the recognition and measurement principles under IFRS 16. Last thing just to take a look at then is the presentation, disclosure, and effective date. Now, like any good IFRS standard, there's a whole lot of presentation and disclosure, and I'm really not going to spend a lot of time going through them because it could take almost an entire webinar to discuss in detail just what's wanting. But you need to obviously present the following things. So I just really want to talk through the main impact. Remember, obviously, for the asset, we are now going to see a right of use asset on your balance sheet. Remember, you would need to present that separately or include the right of use assets in the same line as you've got with other owned assets. And then, of course, in the disclosures, separated out. But there is going to be an increase in your assets there. For investment properties, those are always disclosed as investment property. So even if it's a right to use, if it meets the definition of an investment property, any right of use assets in that classification go under the investment property section. And of course, on the liability side, you're now going to have that ominous liability. The ISB is talking about, when they did some of their outreach, they were talking about in the region of $3 trillion coming onto balance sheet on the liability side. So it's going to be interesting to see how that pans out in practice. Once again, you can show that liability separately, or you can include it with other liabilities, providing somewhere in the disclosures you do separate out those that relate to leases and those don't. Just taking a look at the following diagram illustrating that. You can see there that the I-17 column, the finance lease guys had some assets and liabilities on balance sheet, really didn't have much off balance sheet. But the big impact is obviously going to be those of you who have a lot of operating leases. Remember, for you, all the assets that you had, cars, buildings, planes, I think especially the aviation industry are going to feel this one. All of those assets are sitting off balance sheet as well as all the liabilities relating to it. Remember, that's that $3 trillion that the ISB reckons is going to come onto balance sheet. All of those now are going to be on balance sheet under IFRS 16. So everything coming on there, increasing the asset, but more importantly, increasing the liability side. In your statement of profit or loss and other comprehensive income, the changes there, effectively, we're going to see the interest on the lease liability needs to be disclosed separately from the depreciation on the right of use asset. So where previously you would have just had operating lease expense, now we're going to have two line items being impacted, being the interest line and the finance line, and of course you're going to have depreciation on the asset. Note, however, that the interest line is a bit of a sensitive line for some of you, especially those of you who've got certain debt covenants, so you will just need to be looking at those kind of ratios to ensure you don't break those. Also, just looking at a breakdown of that graphically, as I said, the operating lease was just that single operating cost that was sitting there. We're now going to have this broken down into your depreciation and your interest. Remember, certain key figures, things like your EBITDA and that, those are going to be impacted, because whereas your operating lease expense was included in your operating costs, working out things like your EBITDA, that's your earnings before interest, taxation, depreciation, amortization. Because these are now depreciation and interest, these would fall down below there. So depending on the type of measurements you use, you can see quite a change happening in those. Other than that, there is obviously a whole lot of disclosures that the ISB wants. And remember, the objective is the same as it almost is in any IFRS standard. They'd like you to provide enough information so anybody using your accounts can effectively assess the impact of leases on your financial position, your performance, and the cash flows of your business. They are not only just qualitative, but also quantitative disclosures you're required to give. So I think, definitely since the I-17 wasn't that onerous, I think you're going to see a lot more disclosure, especially a lot more on the talking about how leases have impacted you under this standard. So when is it effective? 1 January 2019. So this one comes into effect, seems like a fair way away, but the warning I give to many people is we're in for a couple of rough years. You can obviously early adopt this if you want. You can early adopt it, but if you do early adopt IFRS 16, you also are then required to early adopt IFRS 15 on revenue. Now, I said I think we're in for a couple of rough years because I think, remember that 2019 seems far away, but the year before that, being 2018, you'll have to adopt both IFRS 9 on financial instruments and IFRS 15 on revenue. My advice to people continues to be that I think those two standards will be quite tough to apply in 1 year. So I always think you should early adopt one of those, which means I think in 2017, you should have either IFRS 9 or 15, 2018, the remainder of the IFRS 9 and 15, and 2019, IFRS 16. So you could see quite a big impact over the next 3 years as we have three major standards coming to play. But it's your choice. Obviously, you can early adopt it if you believe this accounting will be much better for you. So that, ladies and gentlemen, is a summary of IFRS 16. I would say I think there's a bit more to it. There is obviously the devil is in the detail. We only recently got the standard early in 2016. So I think as everybody starts working through it in practice and we start seeing the practical challenges, we will come back to you, probably revisit the standard in another webinar at some point when we've got a bit more practical insight into it and take you through some of the practical areas people are seeing. But for now, that's IFRS 16. So we'll open up to see if there are any questions from anybody. If there are, if you don't want to do it during the webinar, please do feel free to mail me and I'll see if I can help you on that. We are developing an e-learning module on this, which will probably be out in the next couple of months, which will help you out in terms of rolling out. Remember, you can get that through the Fundamentals e-learning on your IFRS KMA. Right. I don't see any questions coming through at the moment, so that's it. I'll say thank you very much, folks. I hope you enjoyed the webinar. Remember, there is a recorded version of this webinar that will be placed on the KMA if any of your colleagues have missed it. And also, if you are wanting to get CPD for this webinar, all you will need to do is go onto the knowledge management application. If you go into the e-learning, the fundamental side, you will see their webinars. If you go to the IFRS 16 one, you can then click on the quiz. 10 simple questions to see if you've been listening to me. If you have, and I'm sure most of you have been listening very closely, you will be able to get an hour's CPD for this module. Okay, folks, that's it for me. Thank you very much. Take care.